Hey, we're back here with Anthony Smith, our lead economist, for another shipper update today. Anthony.
That's right. So, Andrew, quick recap on what we're kind of talking about. We're talking about inflationary pressures, of course, but they're starting to ease, and that's a good thing. And so when we're looking at these easing inflationary pressures, doesn't mean that they're going to completely drop and fall off a map. They're going to remain elevated generally when we're looking at, of course, year-over-year levels. So behind me, I have producer price index on a year-over-year change for all commodities, but one of the ones that you might be a little bit more familiar with is just the overall PPI. For those of you that are looking at some of these headline numbers, and what we've seen there was that it increased 0.5% overall. When you take out some on the month-to-month basis, but when you take out some of the volatilities, things like food, things like that, I think it was up 0.2%. So we are starting to see some significant easing there as well. So good signs, but we're looking at what's going on with the freight industry. We're looking at what's going on within goods, commodities moving throughout the country. The biggest headwind isn't the prices. It's really, do you have it, and can we get these things in position? Can we actually use these goods? And so in the next chart here, we're looking at it in a more flatbed perspective. And so we're looking at non-defense capital goods new orders in the orange line, and of course our flatbed outbound tender rejection index in the blue line. And so looking at non-defense capital goods new orders year over year, excluding aircraft, is a long-winded way of saying business to business activity. So we take out defense spending, we take out aircraft because those are usually big ticket items that are volatile, throw off the seasonality or any kind of underlying trend. And so when we're looking at that, we're seeing that it's remained elevated. We're seeing this month-to-month upward movement for non-defense capital goods new orders, excluding aircraft, on a year-over-year basis. And so when we're looking at it, it's fun to say. I can't stop myself.
It is. You're really good at it, too. It's like you've been saying it for a decade or something.
I have been, nearly that. And so when we're looking at this number, it really shows that there is a lot of momentum left in the tank. And so looking at these orders come in, those durable goods means that there's going to be a lot of flatbed activity. And Andrew, we know when we look at these orders, there's a seasonality to these things. You're an economist, you know that things move in trends. And at a certain point in time, these trends, someone's going to be left holding the bag. You're also, I think, into finances as well, very much so. Someone sometimes is left holding in the bag because you see a stock rising, 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 rising. You jump in, you're trying to ride that wave up, but you should have been in months ago. And so a lot of things that we're going to be looking at now is, are you doing investment that you really should have done months ago, now that you're kind of in the midst of it? And I think that's really the big aspect for a lot of shippers, a lot of producers. Upstream, are you doing the things that you need to do to get to where you need to be 2-3 years from now? And as you mentioned in the last segment update, that's hard to do. It's hard to time that, especially when you just come out of the year and a half that we've just seen.
I think that's a really good point because somebody may question what's the difference in doing it now and doing it 6 months ago. Well, look at that producer price index. Know that the commodities that you're going to need to build the factory or build the warehouse, or if you're going and needing new facilities, the prices of those have gone up a lot. So it's not that maybe it's not that it's too late now. It's that you're going to be paying more for it now. Yeah. And if we have this downturn in 2022, which it's up in the air, we don't know exactly what we're going to see. But if things turn quicker than we are expecting them to, that's what we mean by left holding the bag. Yeah. You overpaid for your infrastructure that you might not even need now. Yeah. That's kind of the point here.
Exactly. Well put. And I mean, that goes across the board, whether you're upstream, downstream, hiring for what you really, because really, from my perspective, anticipating still more rapid growth in 2022, just not at this, hyperdrive speed, as Michael Vincent put it. I love that phrasing there. When you're looking at the pace, it's going to slow, it's going to ease, but you're still going to be incredibly busy. So it's important to think about what decisions you need to make ahead of time before you actually make them. Because if you're making those large capital goods expenditures because you need them now, you're not sure if you're going to need them 6 months from now, a year from now, 2 years from now, you have to reevaluate a few things. And so I think that's going to be the big thing here. And I think we have one more chart potentially here that we can kind of get into. And this is looking at the overall durable goods. And so I like to look at the durable goods, of course, because this is going to be pertain or going to really kind of tie closely to actual freight and transportation. And so we're looking at overall durable goods on a month-to-month basis. Dollar value, of course, we're seeing that we're past the pre-pandemic level and we're still seeing some upward movement here. And so really overall what we're seeing across the board is that there is still a lot of activity going on. Of note, all this is really upstream, and I think that's really kind of where it starts to get the momentum. Kaylee had and I had a great conversation along with Bill, one of our producers here, talking about what's one of the things that can kind of derail what we're seeing right now. And I think it's all come down to the consumer. And of course, I'm going to talk to some of those consumer trends in tomorrow's initial jobless claims report. And so we're going to be looking forward to that. As long as those consumer bases remain stable, demand can really kind of push a lot of things through.
Yeah, going to need to keep the labor market chugging right along and just try to get a hold of some of these supply chain bottlenecks so that we can kind of grapple with this inflation that we're seeing that hasn't been transitory so far, but it's not transitory in the sense where it's not sticky in the sense that we're seeing it across the board. We're seeing it because of supply chain bottlenecks, and that's what we're really seeing the driving inflation. But all right, Anthony, great stuff from you this morning.